Hey everyone, welcome back to the channel. Today, we're diving deep into a major financial development that's been shaking global markets. The surprising surge in US long-term Treasury yields, even after the Federal Reserve began cutting interest rates. What's going on here? Why are yields still rising when rates are supposed to be going down? Let's break it all down so you can understand what's happening behind the scenes in the US bond market, and why it matters to all of us. 1. What's going on with US Treasury yields? Since September 18 last year, the US has cut its benchmark interest rate 3 times, totaling a 1% reduction. Normally, when the central bank lowers rates, bond yields also fall. But something very unusual is happening. Since the first rate cut, 10-year US Treasury yields have actually gone up, and as of now, they've broken past 4.5%. That's much higher than where they were before the rate cuts began. Back then, the 10-year yield was just 3.6%. So, why is the bond market acting in the opposite direction of central bank policy? 2. 3 reasons yields are rising. There are 3 main reasons why US bond yields aren't falling like they usually would. Inflation fears are back. Investors are worried inflation might come back. When inflation rises, the value of money falls. So, lenders demand higher interest rates to compensate for the loss of purchasing power over time. Massive US government borrowing in 2025. The US is expected to issue an unprecedented amount of debt in 2025, possibly the largest issuance in American history. When the supply of bonds increases dramatically, yields tend to go up. Falling foreign demand. Foreign investors, especially major holders like China, are becoming hesitant to buy US Treasuries. Political tensions and trade conflicts under Trump's administration have eroded trust and interest in US debt abroad. 3. How much debt are we talking about? There's also some confusion in the media about how much US debt is actually maturing soon. Some reports claimed only $3 trillion in US Treasuries are maturing this year. But those numbers referred only to very short-term bonds, less than 1 year. In reality, when you include short-term, mid-term, and long-term bonds, $9.2 trillion worth of debt is coming due in 2025. Add to that a new expected deficit of $1.9 trillion, and the US may need to issue over $11 trillion in bonds this year alone. That's a massive amount, and it's never been done before in US history. 4. Why this is a problem? This huge amount of borrowing puts tremendous pressure on interest rates. Let's say the US government wants to borrow $5 trillion more in a financial market that only has $1 trillion in available funds. Naturally, the government will have to offer higher interest rates to attract investors. That means long-term bond yields will continue to rise, even if the Fed wants them to fall. There's another issue. Many of the bonds that are maturing now were issued when rates were much lower, around 3.2%. But to refinance that same debt today, the US has to offer 4.5% or more. This increases annual interest payments by over $150 billion, just in additional interest costs. 5. Misconceptions about US debt. Some analysts argue that the US can just keep printing money and buying back its debt, like it did in 2008 and 2020. But those situations came with consequences, particularly in 2020, when inflation skyrocketed to 9%. If the US were to do quantitative easing again now, inflation could spiral out of control, and interest rates would shoot up even faster. That's why the Fed is stuck. It can't print money like it used to without risking serious. Section 6. Options. The US is considering 630. So, what can the US actually do? Option 1. Change leadership at the Fed. Fed Chair Jerome Powell's term ends in May 2026, but if a new president like Trump wins in 2024 and installs someone more compliant, interest rate policy could shift faster. But that's a big if, and it raises long-term risks for market credibility. Option 2. Loosen bank capital rules, SLR. The US is also considering adjusting the supplementary leverage ratio, or SLR, which determines how much capital banks need to hold compared to their assets. If they exclude US Treasuries from the asset calculation, banks could buy more government bonds. This might help push yields down slightly. But there are risks. If banks buy too many treasuries and interest rates continue to rise, they could suffer huge losses. So banks are likely to be cautious even if the rules are relaxed. 7. Is this a sustainable strategy? Here's the hard truth. These are all temporary solutions. It's like telling a person drowning in debt to just take more loans or bend some rules. In reality, what the US needs is to increase revenue, taxes, or cut spending, just like a household would need to do. But political gridlock makes this incredibly hard. For example, Trump once tried to raise revenue through tariffs. But this actually made interest rates rise, because markets saw it as bad for growth. That's why he backtracked in less than 13 hours and postponed the tariffs for 90 days. Conclusion. In summary, the US is facing a complex and dangerous situation. Massive bond issuance is colliding with inflation fears. Foreign demand is drying up. Interest payments are ballooning. And the Federal Reserve is running out of tools to fix it. It's not a simple case of just printing more money, or cutting rates. Every move has consequences, especially when inflation is still a threat. The road ahead for the US bond market looks rocky, and global markets are watching closely. If you're an investor, a policy watcher, or just someone who cares about where the world economy is heading, keep your eyes on US Treasury yields. They're not just numbers, they're signals of what may come next. Thanks for watching. If you found this video helpful, make sure to like, subscribe, and turn on notifications so you don't miss our next deep dive. Let me know in the comments, do you think the US can stabilize its bond market without triggering inflation or a financial crisis? See you next time.